Greetings everyone and welcome back to Wealth Wizard. In today's video, we're going to delve into the invaluable insights and advice of none other than the legendary investor Warren Buffett on the stock market crash. Known as one of the most successful investors in history, Warren Buffett has a remarkable track record of navigating market downturns and emerging stronger from turbulent times. So, let's uncover the wisdom behind his approach and see what lessons we can learn from him. Understanding Warren Buffett's perspective. To understand Warren Buffett's perspective of the stock market crash, we must first explore his long-term investing philosophy. Buffett is renowned for his emphasis on value investing, which involves seeking out undervalued companies with solid fundamentals and long-term growth potential. Rather than focusing on short-term market fluctuations, Buffett takes patience and disciplined approaches, always looking at the intrinsic value of a company. What sets Warren Buffett apart is his unique perspective on stock market crashes. While many investors panic during times of market turmoil, Buffett sees crashes as potential buying opportunities. He famously advises, be fearful when others are greedy and greedy when others are fearful. In other words, he encourages investors to remain calm and rational when others are caught up in the frenzy of market exuberance or fear. During stock market crashes, Buffett keeps his focus on the fundamentals. He understands that market sentiment and pricing can become disconnected from a company's true value. By staying grounded and assessing the underlying strength and potential of businesses, he can identify attractive investment opportunities amidst the chaos. This approach requires discipline and a long-term perspective, as Buffett believes that quality investments will eventually prevail and deliver returns over time. Buffett reminds us of the importance of staying rational and focused on the long-term horizon during times of market turbulence. By avoiding knee-jerk reactions and maintaining a clear understanding of a company's intrinsic value, we can navigate stock market crashes with more confidence and potentially take advantage of attractive buying opportunities that emerge. Lessons from previous stock market crashes. To gain a deeper understanding of Warren Buffett's advice on the stock market crash, let's examine some lessons from previous market downturns. Two notable examples are the dot-com bubble of the late 1990s and the global financial crisis of 2008. During the dot-com bubble, internet-related stocks experienced an unprecedented surge in prices, fueled by investor speculation. However, Warren Buffett remained cautious and refrained from investing heavily in technology companies. While the bubble eventually burst, causing significant losses for many investors, Buffett's focus on the fundamentals and his skepticism towards overhyped stocks allowed him to avoid substantial losses. Similarly, during the global financial crisis of 2008, Buffett's Berkshire Hathaway took advantage of the market turmoil to make lucrative investments. When fear and panic gripped the financial markets, Buffett seized the opportunity to invest in undervalued companies, particularly in the financial sector. By maintaining a long-term perspective and recognizing the inherent value in distressed assets, Buffett was able to capitalize on the opportunities presented by the crisis. These examples highlight a few key lessons. First, maintaining a long-term perspective is crucial. Rather than being swayed by short-term market volatility, Buffett focuses on enduring values of businesses. He looks beyond temporary setbacks and seeks out companies with strong fundamentals and competitive advantages. Second, Buffett emphasizes the importance of not getting caught up in the hype and frenzy of market exuberance. He warns against chasing speculative investments and advises investors to exercise caution and skepticism. By avoiding overvalued stocks, investors can protect themselves from the risks associated with market bubbles. Lastly, Buffett's success during market downturns stems from his unwavering commitment to quality investments. He looks for companies with sustainable business models, robust cash flows, and capable management teams. The emphasis on quality ensures that the investments have the potential to weather economic storms and deliver long-term returns. By learning from Warren Buffett's experiences during previous market crashes, investors can glean valuable insights. It's crucial to resist the temptation of short-term gains, focus on quality investments, and maintain a long-term perspective. By doing so, investors can position themselves to navigate market downturns with confidence and potentially seize opportunities that arise amidst the chaos. Buffett's advice for investors during a stock market crash. Warren Buffett's advice for investors during a stock market crash revolves around several key principles that have guided his successful investment career. Let's explore these principles in detail. First and foremost, Buffett highlights the importance of having a well-diversified portfolio across different asset classes and industries. Diversification helps to spread risk and minimize the impact of any single investment's performance on the overall portfolio. By allocating investments across a variety of sectors, investors can potentially mitigate the effects of a stock market crash in one particular industry. In line with his focus on long-term value investing, Buffett advises viewers to concentrate on companies with strong fundamentals, competitive advantages, and consistent earnings growth. He stresses the importance of understanding a company's business model, evaluating its management team, and assessing its competitive position within the industry. By investing in quality companies with sustainable business models, investors can increase the likelihood of weathering a stock market crash and potentially benefiting from their long-term growth prospects. Buffett emphasizes the concept of a margin of safety when making investment decisions. This means purchasing stocks or other assets at prices significantly below their intrinsic value, creating a cushion of protection against potential downside risks. By avoiding speculative or overvalued stocks and focusing on investments that offer a margin of safety, investors can position themselves to withstand market turbulence and potentially profit when the market eventually recovers. Another key aspect of Buffett's advice is the significance of maintaining a cash reserve. During a stock market crash, opportunities to buy quality assets to attractive prices may rise. Having cash on hand allows investors to capitalize on these opportunities when others may be forced to sell at depressed prices. By keeping a cash reserve, investors can take advantage of attractive buying opportunities that emerge during a market downturn, potentially enhancing their long-term returns. By following these principles, maintaining a well-diversified portfolio, focusing on companies with strong fundamentals, seeking a margin of safety, and keeping a cash reserve, investors can adopt a more disciplined and strategic approach during a stock market crash. These strategies align with Buffett's philosophy of seeking long-term value and taking advantage of market inefficiencies. Now that we have explored Warren Buffett's advice on understanding and navigating a stock market crash, let's move on to practical tips that viewers can apply to their own investment strategies. First and foremost, conducting thorough research is essential. Stay informed about market conditions, economic trends, and the specific industries and companies you are interested in. Keeping up with the latest news, financial reports, and expert analysis can provide valuable insights and help you make informed investment decisions. While it's important to gather information independently, seeking professional advice can also be beneficial. Consider consulting with a financial advisor or investment professional who can provide guidance tailored to your individual circumstances and goals. Their expertise can help you navigate market downturns and make sound investment choices based on your risk tolerance and financial objectives. One practical way to achieve diversification and gain exposure to the overall market is by investing in index funds or exchange-traded funds, ETFs. These investment vehicles offer broad market exposure as they track a specific index or sector. By investing in these funds, you can reduce individual stock risk and benefit from the overall performance on the market. Regularly reviewing and rebalancing your portfolio is another crucial tip. Over time, the value of your investments may fluctuate, leading to a deviation from your initial asset allocation. Periodically reassess your portfolio and make adjustments as needed to realign it with your long-term goals. This process ensures that you maintain the desired level of diversification and risk exposure. By following these practical tips, conducting thorough research, staying informed, seeking professional advice if needed, considering index funds or ETFs for diversification, and regularly rebalancing and reviewing your portfolio, you can apply Warren Buffett's timeless advice to your own investment strategy.